Today we will talk about capital structure theory. And before I start, I will show you the same thing again. What is the objective of the firm? It is to maximize shareholder value. And for that, we talked about capital budgeting decision last time, very briefly. Today, I will start talking about financing decision. And in the financing decision, do you remember what we're doing? We're trying to find money for taking projects. Because in this part, we know which projects to take. Now we need capital source to take those projects. So we will try to find optimal capital structure, if there is one. And this optimal capital structure should maximize the firm value. So we will see whether we will be able to do that. And when I say optimal capital structure, I'm talking about optimal mix of equity and debt. When I say equity, I'm talking about issuing stocks. And debt, we talk about debt before. It can be public debt, like bonds, or it can be private debt, like bank loans. Okay? And in this sense, we will try to find the right kind of equity and right kind of debt to issue. Okay, this is another thing you remember from Tuesday. What is the value of the firm? The value of the firm is the summation of debt and equity. So we have some part of equity and some part of debt, or just vice versa. So what we will try to do is we will try to maximize this pie, the value of the firm as much as possible, and we will try to increase the size of the pie, because this is how you increase the value. And when I say capital structure, again, we're talking about how to finance the projects, where the money comes from. It can be in the form of debt. It can be in the form of common stock or preferred stock. There was one more source that companies use for financing. Do you remember what it was? The biggest source, actually, it's not debt or equity. It was something else. Which is internal funds, exactly. 80% of the money comes from internal funds. And if the money the company has is not enough to cover the cost of the projects the company wants to undertake, then the company will be in financial deficit. In this case, companies will use debt or stock. Do you remember which was more common? Was it stock or debt? It was debt, right? Perfect. So the question we're going to ask to ourselves all the time is, does capital structure really matter? And some people say, yes, it matters. Why? Do you remember the advantages of that? We talk about a few things. One was cost of debt is lower than cost of equity. Do you remember that graph? I have it somewhere. I will show it again. Cost of equity is really high, cost of issuing equity compared to cost of debt. And there was the tax advantage. Do you remember the tax advantage of debt, where it comes from? Let's remember income statement, where basically it was revenue minus cost minus depreciation. So this was EBIT. And from EBIT, we reduce what? Interest. So we end up with taxable income. And from taxable income, you pay tax to the government, and you end up with net income. So if you have debt, you will have interest payments, which will reduce taxable income, which will reduce the tax you pay to the government. So that's a tax advantage, for instance. So people focus on those advantages of debt, and they say, of course, using the right kind of financing is important. But some people say, why does it matter? You're thinking about the same pie. You can slice the pie in 4 or in 8. It doesn't matter. It doesn't matter whether the slices come from debt or equity. It's the same slice of cake, people say. And the article that I assigned to you, which was given the talk by Professor Miller, he says the same thing. I think a pizza delivery guy goes to Yogi Bear, and the Yogi Bear the pizza delivery guy says, do you want 4 slices or 8? Do you want me to slice the cake in 4 or 8? And Yogi Bear says, slice it in 8, I'm hungry. So it's the same pizza, okay? So this is what Modigliani and Miller will say, actually, and we're going to start talking about in like 10 minutes maximum. Okay, so why are we spending 2 weeks on capital structure? Why are CEOs thinking about what kind of debt or what kind of source they're going to use? Probably capital structure will matter. At least in real life, we're going to see it matters. So now let me show you a couple of very simple examples on how debt can affect return to shareholders. Remember, we're trying to maximize the value of the firm. So in this first case, here we have good performance of a company. I'm going to show you 3 different versions of this table. Let's try to understand this one well, and then we're going to move very quickly in the next 2. So suppose that this company has $10 worth of equity, or $7.5 worth of equity, or $5 worth of equity. So 3 different cases. And this company has some debt with 5% interest rate. So this is the interest rate on the debt. So the company can have 0 debt, $2.5 worth of debt, or $5 worth of debt. In all cases, the asset value is the same, right? It is 10, it is 10, it is 10. The asset value doesn't change. So when we calculate debt to equity ratio, it's going to change, of course, because we're using more and more debt. So debt to equity ratio will be 0, which is 0 over 10. Or it will be 2.5 over 7.5, 0.33. Or it will be 5 over 5, which is 1. Clear? OK. EBIT, I'm giving it to you. It comes from, it comes from the sky, let's say. EBIT is $2 in each case, earnings before interest and taxes. Interest payment depends on how much debt you have. It's always 5% of what you have as debt. So 5% of 0 is 0. 5% of 2.5 is 0.125. 5% of 5 is 0.25. So these are the interest payments for the debt you have. So earnings before taxes, taxable income, will be 2, 1.8, or 1.75. This is simple, right? Is there anything that's not clear? No? OK. The tax rate in the, in the economy is 40%. So 40% of 2 is 0.8. 40% of 1.8 is 0.75. 40% of 175 is 0.7. So you end up with net income. And these are the net income in all those 3 cases, which is taxable income minus tax. Again, simple. So you end up with net income. And in each case, we're going to calculate return on equity. What is return on equity? Do you remember return on equity? Income over equity, right? Net income over equity. So this is 1.2 over 10, 12%. This is 1.125 over 7.5, 15%. 1.05 over 5, 21%. So as you can see, the more debt you use, you increase your return on equity, which is a good thing. So you see that when the company has good performance, this is the good performance case, because EBIT is $2. In the other cases, I'm going to reduce EBIT. When a company has good performance, increased leverage is a good thing. It increases return on equity. And you all see this, right? OK. The other examples, I'll move fast, I promise. So in this case, I put average performance. Everything is the same. I'm just changing EBIT. So this time, instead of giving you $2 EBIT, I'm giving you $0.5 EBIT. In this case, again, I'm doing everything the same. I'm not going to go over them. And I calculate return on equity in each case. And it is 3%, 3%, 3%. So increasing debt had no effect on return on equity when you had average performance.
What about the decimal of return on equity?
Oh, it's the same. It should be the same. OK. So good performance, leverage increases return on equity. Average performance, leverage doesn't affect return on equity. Let's look at the bad performance. In this case, I'm giving EBIT to be equal to 1, minus 1. So there's a loss for this company, really bad performance. In this case, if you calculate return on equity, it's going to be minus 6%, minus 9%, minus 15%. So this time when you increase leverage, what happens to return on equity? Return on equity decreased. So when the company has bad performance, we see increasing leverage actually affects return on equity in a bad way. What is the bottom line? Leverage amplifies the effect of good or bad operating performance on return on equity. That's why it's called leverage. So in good times, that makes everything better. In bad times, that makes everything worse. Okay, let's look at another example if you don't have any questions. Yes, Alica?
Why, if we have negative income earnings, why did we pay the tax? Why there is a tax? So there is negative earnings.
Okay.
Minus $1, minus 1.25, but there is also tax. Why there are?
Why are we paying taxes, even if we are?
Actually, we are gaining the tax here. We are not paying because they are minus. Why there is a tax?
Okay, why it's the case? Okay, your homework is create the same table, okay? But instead of using EBIT as minus, use it as a positive thing. It can be 0.01, it doesn't matter, and try to create return on equities. And think that why taxes is negative here. Oh, one more thing. Last time, Batu, this R effect. You asked about İşbank and whether they have different stocks. I couldn't find anything on it. So, again, your homework will be to look for it. Huh? No, when I say homework, this is not, you don't even have to submit it, okay? It's just something that you can share with us. Remember, the purpose of this class is all learning together, okay? So I look for, remember I said Google has different types of stocks, type A or type B, and it has different voting rights. Type A stocks has 1 vote right, or type B has like 10 vote rights. So, but to say, I think İşbank has more than one type of stock. I searched for it, I couldn't find it. So if you can look for it and share the information with us, I will really appreciate it. Don't do it now, though. Don't do it during the class time, okay? Okay.
I think in television, there's the teletext part. I think here it has some different stocks.
I look at balance sheet for the information. I couldn't find it.
Different because for the creators of the bank, like İşkur, is exclusive for the creators of the banks, but it's also traded in the market.
Okay, just send me the link with it. Just okay. I mean, I trust you, but I'm in academia, so we have to show everything with references. Even in every graph, you will see my references. I pay a lot of attention to that. Okay, very good. So let's look at another example. So consider that we have an all-equity firm, and this firm wants to have some kind of debt. The firm borrows $8,000, which is debt, and buys back 160 shares at $50 per share. So they're repurchasing stocks, actually. So in the current form, the assets of the company is worth $20,000. The company doesn't have any debt. It's an all-equity firm. So everything is in form of equity. Debt to equity ratio is 0 because that is 0. Interest rate is not applicable because the company doesn't have any debt. Shares outstanding, suppose that this company has 400 shares outstanding. This is the current case, no debt case. The share price is given at 50. In the proposed project, let's say, the company will still have $20,000 worth of assets, but it will have $8,000 debt. This time, the remaining part will be equity, which will be $12,000. Debt to equity ratio will be 8,000 over 12,000, which is 2/3. Interest rate is it given? It is 8% given. Shares outstanding. What's going to happen to shares outstanding? So we had 400 shares. We're going to buy back 160 of it.
It will decrease, right?
Huh? It's going to decrease to 240. And share price is supposed still at 50. Okay? Forget about the market reaction, what's going to happen to stock price. We're going in very basic steps. Okay? So in this case, let's look at what's going to happen to earnings per share and return on equity. So under the current structure, all equity case, we're going to look at 3 different forms of economy. We might have recession, we might have normal times, or we might have expansion. So EBIT will be 1,000, 2,000, or 3,000, depending on where we are in the economy. If in the current structure we don't have any debt, so interest will be 0, 0, 0. So net income will be 1,000, 2,000, or 3,000. So how do we calculate earnings per share? I put it in the slide. It is net income over shares outstanding. So we have 400 shares in each case, and income changes in each case. So you can calculate return on equity. It's going to be 5%, 10%, 15%. Okay, so this is the current case. Let's look at what happens under proposed structure. In the proposed structure, EBIT will be the same in each case. I mean, in recession, expected, and expansion cases. Same with the current structure. But we're going to pay 8% interest on how much debt we have. Do you remember it? 8,000. Thank you. So we are paying 8% interest on $8,000 debt. So this is what's going to happen to our net income. Okay. Again, you calculate earnings per share, but this time numbers of shares outstanding is equal to 240. So you're dividing net income with 240 each case. This is what happens to your earnings per share. This is what happens to your return on equity. So if you compare return on equity with the previous case, in the previous case it was 5, 10? Wait a minute. 5, 10, and 15. So the current structure is good in which time? Being all equity is good in which case? Recession, expected, or expansion case? In the recession. So if you're a risk-averse CEO, what are you going to go with? Are you going to go with the current structure, or are you going to have some debt? You're risk-averse. You're going to go with current structure because return on equity is better when you don't have any debt. When you look at expansion or normal times case, though, leverage makes things better. So if you're less risk-averse or risk-neutral, then you would be okay with taking some debt. The same idea, the similar intuition, just a more numerical example, let's say. So basically, when we're thinking about debt, this is what we see. If you draw a graph with EBIT and with earnings per share, without any debt, this is what you're going to see with the numbers we just used. With that, we're going to have something like this. As you can see, we're going to have a steeper relationship between earnings per share and EBIT when you have some debt. And what this shows is you have some break-even points on the left-hand side. Which one is better? Is having debt good or no debt good? Which one's? No debt case is better because you're having more earnings per share per EBIT. That's a good thing. After the break-even point, though, you have more advantage if you have some debt. Clear? I have only one minor question here. Why do you think this line is steeper when the company has some debt? It's not very easy to see, but think about it.
Leverage, maybe because of tax.
So basically, this means as you increase EBIT, earnings per share will increase more if you have debt. Think about the example. What is earnings per share?
Because of net income.
It is income over what? Numbers of shares. When you have that case in the proposed structure, do you have less or more shares outstanding? Less. That's the case, right? So when EBIT increases, you're distributing it into less numbers of shares. So earnings per share will increase more. That's why it's steeper. I mean, in that case, because you buy back securities. Okay, it was just a minor question. Now we can finally start capital structure theories. So I'm going to start with trade-off theory. We're not going to have time for pecking order or market timing. I'm going to actually cut kind of in the middle of Modigliani and Miller today. And next week, next Thursday, we're going to talk about pecking order and market timing. I will actually I will upload another set of slides which will give you the evidence on capital structure theories. So I will give you real-life examples of everything we see next week, next Thursday, after finishing all the theories. Okay, so again, what are we trying to do? We are trying to maximize the value of the firm. Do you remember this little guy from Tuesday? So the value of the firm depends on cash flows the company generates. And of course, since we are interested in the value of the firm today, we are discounting all those cash flows with the appropriate discount rate, which is weighted average cost of capital. Do you remember what weighted average cost of capital was? You don't have to give me the formula, just the idea.
This is a hurdle rate that the company accepts the projects over that rate. It's just like cost of the company.
It's cost of financing, right? Exactly. Weighted average cost of capital. And you will take projects if weighted average cost of capital is less than the return that project will generate to you. What kind of financing, what kind of cost we can have? What kind of financing can we have? So this is weighted average cost of capital. What is the weighted average part? It's debt or equity. So we have cost of equity and cost of debt. So together, we're going to solve examples on this today, so don't worry. So this is weighted average cost of capital. And this is the basic present value formula, if you remember. So you discount all those cash flows, you bring the values to today. And as I said last time, if your capital structure doesn't affect this part, what is the only way to maximize the value of the firm? To decrease weighted average cost of capital as much as possible, right? If you make this smaller, when this is fixed, you're going to increase the value of the firm. So today, this is what we're going to see. We're going to assume that capital structure doesn't affect cash flows. And we will try to see whether changing capital structure will really change weighted average cost of capital. Okay, this is what we will try to do. So we said we are trying to maximize firm value by minimizing WACC, assuming that we cannot affect cash flows. We know that debt is cheaper than equity. There's tax advantages with it as well. But we also know that there's a problem with that. If you increase debt a lot, you increase the possibility of bankruptcy. So basically, what we will try to do is choose the debt to equity ratio, which will minimize weighted average cost of capital. It sounds very simple. It's, of course, not very easy in real life. And what we're going to see is we will be aware that capital structure indeed affects the cash flows. So we cannot say ceteris paribus, as all econ people say all the time, and like holding everything else constant. It's never constant. So this part will complicate everything. But in general, this is the picture we will have in our mind. So we know that cost of debt is lower than cost of equity, and we know that weighted average cost of capital is the weighted average of those two costs. So it has to lie in between. So what we will try to find is, if there is one, we will try to find this point which may, the optimal debt to equity ratio, which will minimize weighted average cost of capital, which will maximize the firm value. So for this one, Modigliani and Miller came up with a very interesting theory. They actually got a Nobel Prize with it. And this year, finance people got Nobel Prize. Probably like first time ever. Generally, econ people takes those. And when the camera is off, I will give you like gossips about those people. Modigliani and Miller came up in 1956 with a new idea. So they said, forget about the traditional view, And they say capital structure is irrelevant. Why are we spending time on it? It's irrelevant, they said. So this was it was a big thing at that time. But they made very, very simplifying assumptions. Like even in this stage, like as as university students, you will be aware how basic those assumptions are. So they assume there are no taxes in the economy. They assume there's no bankruptcy. They assume there's no transaction cost, so you can easily exchange stocks and debt and everything. And they assume financing doesn't impact operations. Very simplifying assumptions. And they actually prove those by arbitrage and law of one price. And I'm going to show you the proofs as well. It's not very complicated. Later on, Miller wrote another paper, and he relaxed a couple of assumptions. So he included taxes, for instance, but he concluded the same thing. He said capital structure is irrelevant. So today, I'm going to spend most of the class showing you capital structure is irrelevant. Then I'm going to relax some assumptions, and we're going to see how things will change when we relax assumptions. First, I'm going to introduce taxes. Then actually, I will stop. Next week, I'm going to introduce bankruptcy, and we will see how things will change. OK, so as a starter, the simplest world with no taxes, no bankruptcy. So in this world, we're going to assume there are two firms. They have the same operating cash flow. Company U, it is unlevered, all equity firm. And company L, it has debt and equity both. So it's the levered firm. And we're going to assume that we're going to buy 10% of the unlevered firm and 10% of the levered firm. So my investment will be 10% of the unlevered firm. And from the investment, what am I going to make? My return will be 10% of the profit the company generates. Very simple case, OK? Forget about dividends and everything. In the other case, you're buying 10% of the levered firm. So since it is levered, you own 10% of the equity and 10% of the debt, because the company has both. So in this case, you own 10% of the debt, 10% of the equity. So together, you own 10% of the entire firm, which is VL, levered firm. What is my return? As a debt holder, I'm going to get 10% of the interest payment. And I'm going to get 10% of what is left out after interest payment was done, profit minus interest. So total 10% of the profit. So from here, if your return is same, you're getting 10% of profit in both cases. If there are two investments with the same return, what do you expect from the investment? Values? Should they be the same, different? If you get same return from two investments, what does law of one price say? What does no arbitrage say? Huh?
Price of the firm should be the same.
Thank you, Yiğit. Yiğit, right? Thank you. If there are two things with the same return, their prices should be the same, right? So in this case, 10% of VU will be equal to 10% of VL, right? Because they have the same return. We're assuming that capital structure doesn't affect profit. Those profits are the same. So what is the conclusion of the proof? VL should be equal to VU. So whether the company has debt or not, it's irrelevant. The value of a levered firm should be equal to value of the unlevered firm, if we assume that capital structure doesn't affect profits. This is Modiglia and Miller proposition 1, actually. So can you understand what you read in the article now a little bit better? OK, that's the idea. OK. But remember, we're in the no bankruptcy, no tax case. In that case, the value of a levered firm should be equal to value of unlevered firm. Very important assumption is that very important assumption is that capital structure doesn't affect cash flows of the firm. That's our simplest assumption. And firm value is determined entirely by the cash flows. That's it, not the capital structure. So no matter how debt equity, the ratio of debt to equity you use, there's no optimal debt to equity ratio because no matter what you do, you cannot increase the value of the firm. So this is Modigliani-Miller proposition 1. Capital structure is irrelevant. When we talk about, when we think about that. If capital structure is irrelevant, what kind of debt you're using is irrelevant. Long-term, short-term, senior, subordinated, whatever you can think of, it's all irrelevant. What kind of stock you're issuing is all irrelevant. Common stock, preferred stock, type A, type B, it doesn't matter. None of those decisions will affect the value of the firm. So if value of the firm doesn't change based on the capital structure, let's go one step further. We're going to move to proposition 2. So the value of the unlevered firm will be this, right? Cash flows over 1 plus WACC. For the levered firm, it's going to be the same. Cash flows, remember our assumptions, cash flows were the same for those firms. But for the levered firm, we're using WACC L. So if these two things are same, when cash flows are same, what do you see here? What do you see here for WACCs? WACC should be the same, exactly. So Modigliani-Miller proposition 2 says what? It says the firm's cost of capital is unaffected by capital structure. So you cannot minimize WACC by changing your capital structure. Are you tired? Are you doing okay? Okay, I'm going very slowly, I know, but I think this is good for now because I'm going to show you something very ugly now. Okay, ready? Yes. Okay, so we said weighted average cost of capital is same. It is irrelevant of capital structure. Now let's focus on cost of equity. Okay, so cost of assets, or return on assets, okay, is weighted average of return on debt and equity. Same with WACC idea. So this is weight of debt, cost of debt. Remember, there are no taxes. That's why we don't have 1 minus t here. Plus weight of equity, cost of equity. So together, they're going to give you the cost of assets, or return on assets, which is equal to WACC of an unlevered firm, by definition. Here, some magic happens, okay, simple things, and you come up with this. So cost of equity is equal to, or return on equity is equal to return on assets, which is basically the risk of a company, or return on a company if the company doesn't have any leverage, plus you're introducing some additional risks due to leverage. So as you can see from here, if this part is positive, return on assets minus return on debt is positive, increasing debt will increase cost of equity. So now we are moving into something like this. And try to be awake for a while, because this part gets confusing for some students, okay? Just wake up, okay? So cost of equity is increasing in debt, and I'm going to show you where it comes from with betas and CAPMs and stuff, okay? But cost of equity increases as you increase debt. Cost of debt is fixed. It doesn't change with debt, and it is lower than cost of equity. And weighted average cost of capital is going to be fixed. The idea is same. Remember, we said weighted average cost of capital doesn't change when you change the debt to equity ratio. So it should be a straight line. But my question to you, I mean, the answer is written here, but I want you to give me an answer understanding this. if cost of equity is increasing in debt, how come weighted average cost of capital stays constant as you increase debt? I mean, this is fixed, this is increasing. When you take the average of those costs, it's a flat line. Why? Let's wait like 5 more seconds for someone new. 1 Mississippi, 2 Mississippi, 3 Mississippi, 4 Mississippi, 5.
Because as we're increasing debt, we're increasing the debt to equity ratio, so the weights of the costs are changing. So the weighted average stays.
That's exactly one thing. Remember, weighted average cost of capital is what? Weight of equity times cost of equity plus, do you want me to write it? Okay, this is, of course, no tax case. Weight of equity times cost of equity plus weight of debt, cost of debt. So as you increase, as you use more debt, what happens? You're increasing weight of debt. You're decreasing weight of equity. But you know that cost of debt is less than cost of equity. So just stay with me, like one sentence, you can get it. When you increase debt, cost of equity will increase. But at the same time, you're using more of the cheaper financing source. So they're going to offset each other. And weighted average cost of capital will be the same. This is what this note says. Was it clear? I want someone else to try to explain it to me back. Who wants to explain it? This time I'm going to wait till 8. Let's go step by step together, okay? So you start with the first sentence, and then I will continue. It's very important. So you're increasing debts. So what happens to the weights? What happens to the weight of debt when you increase debt? Okay, and it increases, right? You use more debt, so weight of debt will increase. Okay, weight of equity will decrease, right? Because it's slicing the pie. If you cut the slice bigger for debt, the slice for equity will be smaller. You're going very well, okay? And then, is there anyone who wants to step in? So when you use more debt, what happens to cost of equity? If you increase debt, what happens to cost of equity? It's going to increase, exactly. But as you're using more debt, which one is cheaper, debt or equity? Debt. Debt is cheaper, so you're using more of the cheaper financing source. So those two effects will offset each other. I think it was perfect, Olga. Very, very well. Okay, he is right. Did you get what I just said? Okay, perfect. And I thought you were going to ask me why cost of debt is smaller than cost of equity, so I put the slide, which was from the previous slides. It's not in the slides you printed. So we already know that cost of stock is very high. This is cost of IPOs. Then we have cost of seasoned equity offering, which is also equity, cost of equity. Then we have convertible bonds, which is form of debt. And then we have normal bonds. So cost of equity is always higher than cost of debt. So nobody asked us, but it's there if you're interested. Or you already remember it. Okay, I thought this part wasn't going to be very clear. So I put this mathematical example. It's going to show you the same thing. Changing debt to equity ratio is not going to change WACC. So this example shows that thing, just in mathematical in numbers. So I use different debt and equity numbers here. I have 1,000 equity, 0 debt, 800 equity, 200 debt, 500, 500, 100, and 900. So I have $1,000 worth of assets. I'm just slicing it differently. So in each case, you can calculate weight of equity and weight of debt. Let's just do this for this part. So if I have 800 worth of equity and $200 of debt, what is my weight of equity? How do I calculate this? It's 800 over 200? 1,000, thank you. Okay, so it should be equity over assets. Do you want me to write it as V or A? It doesn't matter. Okay, so it's going to be 0.8, and weight of debt will be equal to 200 over 1,000, which is the remaining part. So together it should be equal to 1. Okay, so in each case, I have different cost of equities and kind of different cost of debts. Okay, so when you calculate WACC, this is weight of equity times return on equity, weight of debt times return on debt. So if you do that, you're going to calculate the WACC. In each case, WACC will be equal to 15%. So if you're interested in where this intuition comes from in numbers, this is an example you can find in your slides. So basically, we said cost of equity is increasing in debt when we have no bankruptcy and no taxes, okay? And the rate of increase depends on this difference, okay? And if a company doesn't have any debt, this is going to be equal to 0, and cost of equity will be equal to cost of assets because there's no debt. All the cost or return should come from equity. Very straightforward, right? Okay. Now I want to link it to some risk, but I want to take a break, and then we can continue. Let's take a 10-minute break, and don't be late. End up with taxable income. And from taxable income, you pay tax to the government, and you end up with net income. So if you have debt, you will have interest payments, which will reduce taxable income, which will reduce the tax you pay to the government. So that's a tax advantage, for instance. So people focus on those advantages of debt, and they say, of course, using the right kind of financing is important. But some people say, why does it matter? You're thinking about the same pie. You can slice the pie in 4 or in 8. It doesn't matter. It doesn't matter whether the slices come from debt or equity. It's the same slice of cake, people say. And the article that I assigned to you, which was given the talk by Professor Miller, he says the same thing. I think a pizza delivery guy goes to Yogi Bear, and the Yogi Bear the pizza delivery guy says, do you want 4 slices or 8? Do you want me to slice the cake in 4 or 8? And Yogi Bear says, slice it in 8, I'm hungry. So it's the same pizza, okay? So this is what Modigliani and Miller will say, actually, and we're going to start talking about in like 10 minutes maximum. Okay, so today, we will talk about capital structure theory. And before I start, I will show you the same thing again. What is the objective of the firm? It is to maximize shareholder value. And for that, we talked about capital budgeting decision last time, very briefly. Today, I will start talking about financing decision. And in the financing decision, do you remember what we're doing? We're trying to find money for taking projects. Because in this part, we know which projects to take. Now we need capital source to take those projects. So we will try to find optimal capital structure, if there is one. And this optimal capital structure should maximize the firm value. So we will see whether we will be able to do that. And when I say optimal capital structure, I'm talking about why are we spending 2 weeks on capital structure? Why are CEOs thinking about what kind of debt or what kind of source they're going to use, probably capital structure will matter. At least in real life, we're going to see it matters. So now let me show you a couple of very simple examples on how debt can affect return to shareholders. Remember, we're trying to maximize the value of the firm. So in this first case, here we have good performance of a company. I'm going to show you 3 different versions of this table. Let's try to understand this one well, and then we're going to move very quickly in the next 2. So suppose that this company has $10 worth of equity, or $7.5 worth of equity, or $5 worth of equity. So 3 different cases. And this company has some debt with 5% interest rate. So this is the interest rate on the debt. So the company can have 0 debt, $2.5 worth of debt, or $5 worth of debt. In all cases, the asset value is the same, right? It is 10, it is 10, it is 10. The asset value doesn't change. So when we calculate debt to equity ratio, which is internal funds, exactly. 80% of the money comes from internal funds. And if the money the company has is not enough to cover the cost of the projects the company wants to undertake, then the company will be in financial deficit. In this case, companies will use debt or stock. Do you remember which was more common? Was it stock or debt? It was debt, right? Perfect. So the question we're going to ask to ourselves all the time is, does capital structure really matter? And some people say, yes, it matters. Why? Do you remember the advantages of debt? We talked about a few things. One was cost of debt is lower than cost of equity. Do you remember that graph? I have it somewhere. I will show it again. Cost of equity is really high, cost of issuing equity compared to cost of debt. And there was the tax advantage. Do you remember the tax advantage of debt, where it comes from? Let's remember income statement, where basically it was revenue minus cost minus depreciation. So this was EBIT. And from EBIT, we reduce what? Interest. So we optimal mix of equity and debt. When I say equity, I'm talking about issuing stocks. And debt, we talk about debt before. It can be public debt, like bonds, or it can be private debt, like bank loans. Okay? And in this sense, we will try to find the right kind of equity and right kind of debt to issue. Okay. This is another thing you remember from Tuesday. What is the value of the firm? The value of the firm is the summation of debt and equity. So we have some part of equity and some part of debt, or just vice versa. So what we will try to do is we will try to maximize this pie, the value of the firm, as much as possible. And we will try to increase the size of the pie, because this is how we increase the value. And when I say capital structure, again, we're talking about how to finance the projects, where the money comes from. It can be in the form of debt. It can be in the form of common stock or preferred stock. There was one more source that companies use for financing. Do you remember what it was? The biggest source, actually, it's not debt or equity. It was something else.